This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Alexander Ineichen. He's the author of many books: Absolute Returns, Asymmetric Returns. He has a monthly publication as well. Definitely worth checking out. There are some sample PDFs that you can find in Google Advanced Search and search for PDF documents only. There are some of them out there, and you can check out what he does. For me personally, going back and thinking to my first book, I was definitely influenced by Alexander's writings. He was putting out some of the most clear, concise information about hedge funds and strategies in the late 90s, the early 2000s, and he's never stopped. My first conversation with Alexander, I hope you enjoy.
Do you speak Mandarin already?
No, I don't. And because it's what's hard is when you come here, I'm over 40, so I'm not really in the malleable young mind of learning languages. So I feel like with so much on my plate, I would really have to just immerse myself. I would have to take everything off my plate and immerse myself and just be like, okay, I'm going to die if I don't learn to speak the language.
Yeah.
You guys are lucky. How many languages do you speak? At least two.
Well, at least two, yeah. But I'm not a language person, so I had French at school, but I somehow didn't manage not to pick it up, so I don't speak it. So it's English and German.
Hey, at least two is about 100% more than most Americans, so it's not fair. Hey, listen, let me jump right in because I love when I look at your work. I'm always seeing things and I just want to steal. I want to lift. I want to quote. There's so many things that dovetail right into my world. And I thought one of the things that you're doing right now in your work that is novel, and perhaps other people are talking about it, but perhaps you're the one that's taking the charge, is really diving deep and picking apart the mainstream use of the word forecast. And I want to talk about it today with you and use some examples, not only investing, but other worlds like technology, et cetera. And I think one of the phrases, and I've got, as you talk about, it's very difficult. Experts love to go in a linear fashion. I'm sitting here with 4 pages of notes in front of me, and I don't know how I'm going to go in a linear fashion with you, but I'm going to try. So this long lead up, I would love for you to define from your perspective nowcasting, a nowcaster, and why you've chosen to beat the drum, so to speak, on this phrase.
I don't have a trend following background. So I did in my background is in derivatives in the 1990s, and then in the 2000s I did research on the hedge fund industry. So that's how I came across the idea of trend following. And what I like is taking essentially everything out of the equation except sort of like what matters. And also the simplicity. And then having been, in finance around since the late 1980s, obviously I invest my own money. I have my own, positive and negative experiences. And I've spent most of my time in a research capacity. There is this critique on forecasting. So yes, you can forecast, but as an investor, so there were people who forecasted the last crash, but then you have things like, as an investor, you might know without the benefit of hindsight who will, predict the next one. So there's always someone predicting something. Like there's always an audience for negative forecasts, and then the next crash will come, and then someone will get it right. But it's difficult to identify that group of people as we speak. It's difficult now, and since my research is to 99% institutional, I've sat and still sit in investment committees. The idea was to make the whole investment decision process more robust. I think that was sort of like the initial idea, and it's the what is fluffy in an investment committee is obviously the different egos with the different opinions, and then people throw forecasts at each other, and typically people with a big ego then get angry if other people disagree, and to avoid that, I sort of like came to that nowcasting. So you essentially dump the forecasting essentially. So what the nowcasting does, it just determines a trend. So it doesn't sort of like predict a trend. So for example, in energy for the past couple of years, or in commodities in general, you could have said the trend is not up, right? So, and for example, in gold, that has been true also for a while. So the logic, the investment logic, then, which goes with that trend, is that you're essentially not long, right? You're either flat or you're short, but you're not long. And that, from a nowcasting point of view, you have that attitude, towards that falling trend until you measure the trend reversal. So you do not predict the trend reversal, so you just wait until the trend reverses, and it will reverse, which will have implications for the commodity related currencies such as the Aussie dollar, the Canadian dollar. It'll have an impact on the whole Latin America complex, which over the past months or quarters or years has been negative. But you do not just predict the reversal. And the downside, or let's say the negative of that approach, which I like to call a real-time approach, because you don't operate in the future. You make the decisions in the present. The analysis is the present, so the trend is today. The downside is that you will miss the first couple of percentage points of a move, but then realistically most investors, even if they use forecasting, they will miss the exact turning point anyway. So I don't think that's a huge negative.
Let me add a little detail here to back your point of view. People might be listening and they might be saying, okay, well, Alex is saying forecasts don't work. And they're thinking, well, come on, I see forecasts all the time. This is the way Wall Street is done. And one of the things that you point out in your writing, 2014, 72 out of 72 economists predicted U.S. rates would rise. 72 out of 72. I mean, for me personally, I don't really need to investigate much more that after you hear that. I mean, it's enough evidence. I mean, you're not supposed to just make a conclusion based on that, but that's enough evidence to say, wow, something's really out of whack. And I want to go into a lot more points here, but talk about your initial reaction or even how you came across that data point.
The data point I got from Big Picture, the blog, but I've also come across empirical evidence that is suggesting, or that measured, that with forecasting of interest rates, it's actually less than 50% correct, which means I think I used that in the report, arguing that it's more intelligent at the beginning of the year to flip a coin with respect to the direction of how interest rates, long-term interest rates, will move over the year. Because if you do that at the beginning of every year, you will get 50%. Over the long term, you will get 50% right. But I think there's empirical evidence suggesting that the forecasting, the direction of the interest rates is actually worse than 50%. There is a huge bias to predict rising interest rates. Now, this could be regime specific. It could be just a fact which happened over the past 20 or 30 years, because we're in a regime of falling interest rates in the industrialized world. And it could be that the forecasters just every year sort of like predict or very often predict that it's going to reverse this year, and they just get it wrong all the time. But I thought that was an interesting, let's say, empirical fact. That actually flipping a coin based on that particular research is actually more intelligent. I don't, obviously, that's tongue in cheek, so I don't recommend to flip a coin. But with the nowcasting, you just go with the trend. And in long-term interest rates, in many parts of the world, it has just been down for years and decades. And in an investment committee, I sort of like recommend avoiding this discussion as to, will they turn next month, or for good, as in, is there a regime shift now? Interest rates are off the trough. They reached some months ago, but is this now the big change? I don't recommend to forecast that.
Yeah. Let me dig a little bit deeper on the investment committee experience. I want to quote from your work. Forecasts are an integral part of orthodox asset allocation and are essentially guesswork. In other words, guessing is an integral part of how assets are allocated and risk is taken. Now, I think if you substitute, if we did not use the word forecasting and we used guessing, how much more credibility would institutional and retail investors and traders give to this term forecasting? Why don't you talk about just connecting guessing to forecasting?
I think, forecasting is I'm not saying it's impossible. There are people who get it right much more often than not. But I think it's for, let's say, not everyone is a Warren Buffett, and which means a lot of institutional investors and private investors, they wouldn't know to know, without the benefit of hindsight, who will get it right the next time. And my motivation is not sort of like it doesn't rest on the claim that it's impossible to do. There are good forecasters, but for let's say the 90% of people who might not have access or who do not know which are the good forecasters, I think a more robust process makes more sense, because they are essentially guessing as to they're making guesses, ideally educated guesses about the future, and sometimes you get it right, sometimes you get it wrong, but I think you can make the whole process more stable, more robust by focusing, by essentially avoiding those guesstimations, and focus on the trends, which I perceive as more substantial. Like, for example, take Greece, for example. The trends in equities have been down for a long time. The bond yields have been going up for a long time. So these are well established trends, and yes, there will be traders or people who will make money by predicting the reversal spot on, position themselves, and then have extraordinary returns. But I don't think 100% of the investment community will be in that trade. I think the 90% of the investment community just should sort of like nowcast what is going on. And the result over the past years is that you're flat or you're short, but you're not long. That's sort of like the idea. So it's nowcasting, is not for everyone. I think it's just for 90% of the investment community.
Let's talk about the more specific element here, because when I'm talking about people in the investment committee room or economists, what we're really talking about are people that are held out as experts. One of the problems that you write about with experts is they have this sequential, linear type thinking. And if a storm arrives, the linear thinking, if we really want to break it down as to why forecasting by experts is so difficult, it starts really at this linear type thinking, doesn't it?
Yeah, I would agree with that. But even a crash, which is, or let's say this extraordinary event, which unfolds and happens. It's not, let's take the last financial crash as an example. There have been people, talking about it, predicting it, making money out of it. But that is a very small part of the investment community, like a couple of dozen people, perhaps. And let's say in the hedge fund space, those who were riding that particular trade, they had huge difficulties, raising money and calming their customers because they got it wrong for a long time. So typically, these extraordinary investors, they are typically quite often too early in a particular. In such an extraordinary trade, and which means, and the same is now true for Greece. It could be a rebound, and then there will be some few investors who will get it exactly right. But that, I think, is not something every single investment committee on the planet should aspire to. I think it's more conservative to do the nowcasting thing, and which means you don't try to predict that turning point. But I'm not saying it can't be done. I think it's well,
you're being kind. You're being kind because, of course, in any type situation, statistically, there's going to be some winners. It doesn't necessarily mean those winners don't have skill, but I mean, survivorship issues come into play here, and it should be natural to expect. And you point out this in your writing, and you talk about famously, I think it was in '87, Elaine Gazzarelli, I think is how you say it, and she correctly predicted the '87 stock crash. But then there really, once that fame and adulation hit her, and she was known as the lady that could predict the crash, well, it didn't happen again. And I think that's such a good example. And I think that's what you're really trying to say. You're being careful and you're being nice, but the reality is there just isn't this tremendous amount of evidence of quote expert predictors of events. There's always going to be a winner, as you correctly say. So you see where I'm going. I mean, it's you could be kind to everyone out there, to those people that have had success. But I think what you're really trying to say to investors in your writing is that's probably not the path that you want to follow for your world.
I think that's a fair comment. I'm not sure I'm too kind, but I don't believe that everything is random. So I've traveled extensively, met many investors throughout my career, and I'm fully convinced that there are huge differences in terms of skill and even in forecasting skill. But there's also this element of overconfidence. So if there's a crowd of 1%, it might be 80% who thinks they belong to the 1%. Do you know what I mean? And I think to those 80% who they should at one stage in their career realize that they perhaps not that belong to the 1%. And then I think the nowcasting approach, just focusing, it's a little bit perhaps dull, just focusing on the facts. I mean, it's, if you listen to a good strategist, I mean, they are orators. I mean, they are very well educated, and everyone loves to listen to them, but it's when it comes down to investment decision making, I still believe you can improve the whole process by having like boring stuff like checklists, tick the box, Greece, do you want to take that risk, as an institution? I think it's a box you don't tick, and with the energy complex, same thing. And there's other areas like the U.S. economy doing well. It's a positive tick, and so on. It can be done. I think without forecast.
You as you're talking about boring, you do quote George Soros in one of your most recent pieces of writing.
It's a wonderful quote. Yeah.
If investing is entertaining, if you're having fun, you're probably not making any money. Good investing is boring. And you're saying that loud and clear. It's like, and that's just a fantastic. I mean, most people, even I would think on the institutional side, the retail side for sure, there is this innate belief in human beings that perhaps there's something exciting going on, that there's a guy in front of 15 screens and he's lighting it up and he's got this huge adrenaline rush going and he's making decisions by the moment, and perhaps that guy does exist, as we're saying, with a certain skill. But the reality is that's not how one should be thinking about their portfolio and the risks they take.
Yeah, I mean, it's. I mean, I've got many quotes from George Soros, and I particularly like that one. The Swiss I'm Swiss, and the Swiss are often accused of being boring. So I certainly like the quote, and I think there's with all these quotes, they're tongue in cheek, but I think there's an element of wisdom there where he sort of like hits the proverbial nail on its head. And if the forecasting part, the show element, is part of the investment world, but I think as a, let's say, I'm not saying you should by definition be conservative, but having sort of like a method and a discipline on sort of like these let's say monthly or quarterly investment committee meetings, I think is a step, would be a step forward. You make it might become more dull, but according to George Soros, that's not necessarily a negative.
Let me ask you a question. You just mentioned being Swiss. I've only been to Zurich. And I think my brief experience there, I would say, well, the trains run on time, the engineering's perfect, just there's a certain perfection. Do you find with your Swiss friends and associates that when you bring something to the table, like nowcasting, which in many ways is putting yourself in a position to benefit asymmetrically, to put yourself in a place to benefit perhaps when tail events happen, do you find culturally that many Swiss relate to your style of thinking and investing, or do you find that there's a disconnect?
Well, my client base is quite international, and there's, I think, I would probably say even the majority is English speaking, UK and North America. And, I think it's a difficult question because you have these stereotypes and there's a lot of truth behind the stereotypes, but then you also have, very, Anglophiled investors in Switzerland. So, if I meet Swiss institutions, I think this dispersion of attitude, the dispersion of skill, the dispersion, of risk taking is quite large. And I would argue that's also the case elsewhere. I think when I talk about hedge funds or something new like nowcasting, I think, there's a crowd even in Switzerland, who listens and is very appreciative and open to new ideas. They might not disagree, but they're open. But then you also have the opposite. Like someone who says, I've been doing my work for the past 30 years. I'm still around, so I don't need anything new. So you have both, but I'm not sure that's a Swiss phenomenon. I think I experienced that in many other places in the world as well.
You make a good point. I would like to take this really quickly, and then I want to bring it back to the nowcasting and some of the perspectives that you approach economic momentum, earnings momentum, price momentum. But what I would love to do is talk a few minutes about tech, because you give some great examples to get people thinking about how difficult it is in the tech space. And I think this just gets people thinking about the investing space too. But for example, there was a question, and I'm not sure the exact date of this, but it was a question to Steve Ballmer at Microsoft. And it was essentially asking him about the iPhone. And he really just said, look, there's no chance the iPhone is going to get any significant market share. No chance. It's a $500 subsidized item. And look, Steve Ballmer's a billionaire. He's obviously helped to grow that company. There's been many successful decisions, and there's been a lot done right there. But there you have a great example of somebody who's at the highest level, just looking at an opportunity and saying, no way.
Yeah, I think that's just one out of many examples in the tech space, and I think that the tech space is hugely asymmetric, as in, it's some people can predict the killer app of tomorrow, or when they see it, they spot it. There have been early investors in Google, there have been early investors in some of these companies, but the majority doesn't. And I think it's quite refreshing that I also have a Bill Gates quote from the 80s, or this Steve Ballmer quote from, I think it was 2007. And what I find fascinating with Microsoft, the company, and to some extent also Apple, is this idea of second mover advantage. So Microsoft is a textbook example of not being that innovative. It just takes something which exists and makes it better, or sells it better. And Apple, is perhaps not such an extreme example, but they didn't invent the iPod and MP3 player, and
they didn't invent the cell phone, of course.
Yes, but but their business is hugely successful as just doing something which exists better, and the innovator has then the costs of the innovation, and then they Apple or Microsoft takes over. And it's fascinating. I consider these people are business people, so they're switched on, savvy, and still. When when you look at these predictions, obviously they might have, Steve Ballmer might have throughout his career made 50 extremely good ones, so it's perhaps unfair to him to quote him just on his prediction on the iPhone, but still I think it's refreshing that if you have such high caliber people making these predictions which only with the benefit of hindsight really sound quite silly. I think it's refreshing for let's say all the non-Steve Ballmers of the world.
You point out that experts, and this again I think applies to almost any field, but experts can not only analyze information incorrectly, they can find relationships that are not there. And you talk about illusionary correlation. Why don't you define and explain that?
Well, it's expert failure is I think a very interesting phenomena. I think it has many causes. One you just mentioned. It's in as an expert, or let's say as a scientist, you need to measure things. And I think in physics, if you build a rocket and you go to the moon, it's the science. It's a hard science. But in finance is part of economics, and economics is a social science. It has to do with people, and there the measurement is so much more difficult. But as a scientist, you still have an incentive to come up with a model. So you abstract, and then you hope your model is very close to the real world. But quite often it isn't, and the model might fail in something quite trivial. And we talked about the non-linearities. That's part of the which makes it difficult. And I think sort of like the practical implication of all this is, I think I make the comparison between the sort of like the airline industry, or let's say pilots in an airplane, and hospitals. The risk management in an airplane, they have simple things like checklists, and then when an emergency occurs, they go through these checklists, very very simple and methodical. Whereas in hospitals, it's very there's the main guy, the surgeon who makes all the calls. it's not as methodical, and I think I've quoted somewhere a pilot, or let's say, or perhaps an entrepreneur of an airline firm saying, if their risk management were as comparable to hospitals, they would have every day a plane falling from the skies, meaning that this boring tick the box, checklist approach when it comes to risk management is superior, than just focusing on the expert's opinion, essentially.
You make a good point about the checkbox, because, and I'll just talk to hospitals for a moment. I really think it's probably, if one is going in for surgery, it's probably not a bad thing to ask that particular hospital who's going to treat you, do they use checklists?
Yeah.
It probably makes a lot of sense today.
Yeah, I would agree with that. I came recently. I came across a book, Risk Savvy, by Gerd Gigerenzer.
I've had Gerd Gigerenzer. I've had him on my podcast twice. Gerd's great.
Yeah, I mean that's where I've got that particular quote from the airline entrepreneur, and he makes this point extremely well. The difference between sort of like this methodical approach, boring tick the box, and hospitals where there's I think one of his calls is they really need a reformation, like they need to revise their approaches, because they rely so much on this expert, and they sort of like ignore all this research on expert failure. So they could improve their in quotes investment decision making process, so to speak.
I like how you also talk about, so we're bringing up the idea of illusionary correlation, and how many experts want to move sequentially from one point to another. But you bring up another issue which I have not seen before, which is that a complex problem really can require something, as you refer to, configural reasoning.
Yes, I think the difficulty with complexity or simplicity, I think you need the sophistication first, but then to get to the complexity, and then you simplify, because otherwise it's just simplistic. But I think I think it is important. A system can fail because it's too complex, and then you have causalities which you simply cannot pick up, and then you have this trivial event which then causes a series of causalities, which then brings the plane down, or whatever, lets the power plant fail. So we do live in a complex world. You can't avoid complexity, but then when it comes to decision making, I think you need to break it down. You need to simplify, and I think back to the nowcasting approach, the world is complex. Let's say the relationship with Greece and China, and the relation with commodities and Latin America. So I think it is worth to read history, understand the economics, but when it comes to once you sit once you make the decision, I think it needs to be simplified, because at the end of the day, it's buy or sell, it's buy or sell or hold.
Red or green, off or on, yes or no. You're leading me to where I wanted to go as we kind of wind down, which is your core research. And what we've talked about so far, which I think is terribly important, and obviously you do too, because you wouldn't write so well about it if you didn't think it was important. But we've kind of been laying out the foundation, the philosophy, kind of so-called tearing it apart a little bit. But in terms of your research, the way that you approach the markets, the insights that you glean and provide to clients, you've got three perspectives that you go at. You're looking at economic momentum, earnings momentum, and price momentum. Of course, in my world, I pretty much stick to the price momentum. But you're still, from this nowcasting perspective, you're looking at all three in the same kind of philosophical framework. Why don't you define the three from your perspective and talk about how you use them for clients?
Okay, I mean the price momentum is just straightforward. I just use I've got a medium term momentum, which is shorter term moving averages, and it's just the shorter one crossing the longer one, and then I've got long term momentum. I look at weekly data, so it's like 10 weeks and 40 weeks, and that's I think different people use different moving averages, but that's sort of like the what I call price momentum, and I think that is what everyone else does. But then what I like is really the logic behind it, and then I apply it to economic momentum, or what I call economic momentum. And I build a model which is essentially a composite of some hard data and combined with some soft data, as in a survey, like business surveys and stuff like that. And then what I say is that it's either going up or down, and once it's going up, don't try to predict the reversal. That's sort of like the logic behind that. And with that, with an economic momentum, I believe I cover sort of like the top down space, and with earnings, I look at 12-month forward consensus earnings, and I hope the Bloomberg or whoever does the aggregation doesn't make too many mistakes. So what I get actually quite a smooth line of whether analysts are increasing or reducing their estimates for, let's say, a particular country, or what I think is even more important, of a particular sector. And the logic is, again, a certain trend can last for years. So, for example, in US healthcare, or most healthcare earnings have been just continually reversed upwards, whereas, for example, in materials and energy, I think for years also they have been revised downwards. I do not claim that the analysts, get it right. They have their incentives, and they might not, be spot on. But what I measure with the momentum is the direction. Which I argue is that once you have, let's say, in healthcare, you have positive momentum, it could go on for years, and you shouldn't try to predict the reversal. Just be long, or just consider that as a positive factor when you make decisions, which include, let's say, that particular sector. And for materials and energy, it's nearly like the opposite. And this has been in place for many, for a very long time. And you do not need forecasting.
I mean, I'm like you. I just love this style of thinking, saying, okay, let's break apart how we make decisions. Let's look at how we take risk. And then let's say, wow, is there another way to do this? Is there a systematic way to do this? Is there a way that we can stay in the moment of right now and make decisions, versus clearly all this stuff we've been talking about in this conversation has major pitfalls and potential pratfalls in front of it, relying only on forecasting. And I mean, do you ever find yourself, after all these years working at this and talking to people, do you ever find yourself somewhat amazed that so many people don't think like you?
Yeah, I would affirm that. Yeah, I think that is, but that's, I think, when I was in derivatives in the 1990s, you spend your whole day in a certain frame of mind. And then, you go out, and then suddenly people have a different frame of mind, and they're surprised. I still every now and then, can make someone angry with a certain view, but I think that's, opinions make markets, I think is a saying. I think it's healthy to have different opinions. Obviously, as a researcher, I'd like to think that I spend more time on a certain subject than perhaps, like a salesperson. But still, sometimes, to answer your question, yes, there is an element of surprise if someone doesn't see it the same way. Although I don't think that's a negative. It's a different perspective can result in a completely different bottom line view of something.
Yeah, I wasn't trying to put you on the spot or make it seem like there's only one way, but I guess I sometimes feel like this too, where if one has this perspective, that's outside of the mainstream. And I don't know if we were to kind of loosely group my perspective, your perspective, other like trend type perspectives, quant perspectives into one camp, I would say that camp is probably pretty small compared to the majority. I would still say it's a minority.
Yes, I think the orthodox way is to do asset allocation is to come up with expected return, expected volatility. Then you have, even if it might not be mean variance, it might be more static with rebalancing. I think that is the consensus, but there's also, I think, evolution in that regard. So something a topic which is close to my heart, which we haven't addressed, is this idea of equal weighting. I've been talking or writing about that for many years, and it's something which is picking up. The idea that at the beginning of the year you define your asset classes, let's say 4 or 5 asset classes. You have equal weighting or something very, very simple, no mean variance, anything, and then you rebalance half a year or on an annual basis. So you benefit to some extent from this mean reversion idea, and it's super simple, right? And now there's research actually suggesting that this method is actually not inferior to the much more sophisticated, sort of like scientific bells and whistles kind of approach. And I think that simplifying the world is complex. If you find a way you can simplify, I think without losing. With equal weighting, you simplify. And I think I came across even research suggesting that it's superior on a risk-adjusted return basis. I'm not sure that's true, but I think I'm quite confident that it's not an inferior approach, but it's by definition a much simpler approach, which with pension funds, with perhaps few staff, which it might make perfect sense.
I had a gentleman on my podcast, and I hope I say his name correctly from memory, Spiros Makardakis, and he was putting this together in the late 70s, I believe, a seminal paper where a simple moving average performed better for, quote, predictive value than all of the complicated econometric models of the day. That's really right to where the heart of where you and I are talking right now is keep it simple. And there's a lot, and keeping it simple doesn't mean lack of sophistication. It means that one has taken the time to understand it all and understand that keeping it simple is actually perhaps more sophisticated.
Absolutely. One of my favorite quotes from Leonardo da Vinci is, simplification is the ultimate sophistication. If you dig, actually try to find the proper source of that quote, and he might never have said that, but it's still a good quote. And I think you cannot simplify without the sophistication. So I think you need to think about the complexities, and then if you find something which is not inferior but simpler, I think it's value added by definition. So for example, going back on this let's say nowcasting, or also this idea of equal weighting, if it's not inferior to sort of like the fancy stuff, but you make the whole process more robust and simpler to understand for everyone in the room, then I think it's value added by definition. And with respect to the equal weighting or to the simple solutions, if you collect a lot of research, you quite often find both empirical views. So you still can have a debate whether equal weighting is superior to let's say mean variance. But what I take out of that is, if I see a lot of empirical research, then I just sort of like claim it's not inferior. So let's say if we assume, there's an element of error, it could be, just a bit better or a bit worse. So if we don't know exactly, if it's the same, if there's uncertainty with that regard, but it's very much simpler, then I think it adds value. Obviously, what I do not recommend is going simpler and then having an inferior process. It's keeping let's say the risk adjusted returns constant, but then simplifying the process, which I believe is the value added.
I saw this in your writing, and I kind of just like the simplicity of it. Risk equals exposure to change.
Yeah, that's. I came across that definition in the late 1980s. It's a definition from sort of like an educational tapes from a Chicago-based firm, O'Connor, which sort of like entered a joint venture with Swiss Bank Corporation, which was my then employer, and I think that was sort of like 89, and I still kept that definition. I just, it's simple. It's not scientific. Obviously, it doesn't have a number and has no formula. So if you want scientific, you need a formula. But I think it's from a practical point of view. I think it allows for healthy thinking.
Yeah, and I think that's the whole nice benefit when I see your white papers, I see your PDFs, I see your work, and I'm sure there's still some of them that you can probably search Google and go search for PDF files only. And I'm sure a few pop up still that one can find out there. And people should check them out because it really is. I really like the way, and I love your side quotes too, as I'm a side quote guy too. And you had
I know that. Yeah.
You had a Vulcan one that I loved. A sharp knife is nothing without a sharp eye. Actually, not Vulcan, Klingon proverb. I love it. A sharp knife is nothing without a sharp eye. I love that one too. Oh, one more that I love. This is from 1998. And even though I'm not a fan of his economic viewpoints, and I'm not just saying this because I want to say I've got a better perspective. 1998, Paul Krugman, quote, "By 2005 or so, it will become clear that the internet's impact on the economy has been no greater than the fax machines," end quote. Yeah. That's good stuff, right?
That's a good one. Yeah.
Hey, Alex, where can we send people to your firm? Where can they go to check your website out, check you out?
I've got a website. It's Ineichen-RM. RM stands for risk management, so it's Ineichen-RM.com. And there, you can find my contacts and I've got two types of research. It's my old hedge fund research, but also my new sort of like risk management research, which is where the nowcasting comes from. Yeah,
well, I really like that perspective. I mean, I think. Sometimes I watch these old Alan Watts videos on YouTube, and regardless of whether or not they like him and what he has to say, he does a really good job of staying in the moment of right now. And so clearly nowcasting is staying in the moment of now. So I think it's a good place to be. Hey, thank you for coming on, sir. Hopefully we can talk again in the future.
That'd be great. Thank you very much for the opportunity.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.